Hello and welcome to today's webinar. Before we begin, I wanted to cover a few housekeeping items. At the bottom of your screen are multiple application widgets you can use. All the widgets are resizable and movable, so feel free to move them around to get the most out of your desktop space. A copy of today's slide deck is available in the resource list, and an on-demand version of the webinar will be available approximately 1 hour after the session concludes. It can be accessed using the same audience link that was previously sent to you. 1 hour of Ohio CLE credit is pending for this webinar. If you would like to receive CLE credit, please fill out the survey on your screen. If you have any questions during the webinar, you can submit them through the private Q&A widget without disturbance to the program. We will try to answer these at the end of the webinar, but if a more detailed answer is needed, or if we run out of time, it will be answered later via email. Lastly, if you're having technical issues, you can find answers to common technical troubles located in the Help widget at the bottom of your screen, or you may submit a question via the Q&A widget. As a reminder, this call is for general information purposes only and should not be regarded as legal advice. As always, you should contact your Voorhees attorney if you would like more information or have questions. And now for opening remarks and introductions, I would like to turn the call over to Chris Poth, partner at Voorhees.
Hello, everyone. I want to welcome everybody today to our webinar on the Form 5500 and an overview of the changes that are in place and coming down the pipe, and as well as changes to the audited financial statement process. So I am Chris Poth. I'm joined today by Don Parrish, and again, we're going to give a brief overview of the 5500 requirements, just as a little refresher. It's always good. It's been a couple of years, I think, since we've handled this topic. And then we're going to go into the changes to the content requirements of the 5500, as well as a change that's going to require some process changes for plan administrators for the audited financial statements. And many of you are probably already dealing with that, so we thought we'd do a good explanation of what's covered by that. And then go into some proposed changes that are on the horizon for 2022, and then spend a brief minute talking about the common errors and some audit triggers. So I'm going to hand it over to Don to cover part of the Form 5500 requirements. We're just going to do a quick 15-minute overview on just the basics for everyone.
Thanks, Chris. Yeah, Chris just mentioned we're just going to spend the next several minutes running through some of the Form 5500 requirements as a refresher. So as you know, the Form 5500 is an annual report for an employee benefit plan. The plan is required to file the report under both ERISA and the Internal Revenue Code. Thankfully, the report is a joint report that satisfies the annual reporting requirements of both the DOL and the IRS when it is filed. There are 3 types of filers: pension benefit plans, which are defined benefit and defined contribution plans, welfare benefit plans, and direct filing entities, or DFEs as they're called. Generally today, we're not going to be talking about DFEs, but these are things that include master trust investment accounts, common collective trusts, pooled separate accounts, or some group insurance arrangements, which your plans may have. There are different also filing requirements for different types and sizes of plans, and some plans might even qualify for a filing exemption. In general, if the plan has fewer than 100 participants at the beginning, this is important, beginning of the plan year, then it's a small plan and sponsors must follow the requirements that apply to small plans. On the other hand, if the plan has 100 or more participants at the beginning of the plan year, then the large plan rules will follow, and you have to follow those filing requirements for a large plan. There's also something known as the 80-120 participant rule, which some plans may be able to take advantage of. In this case, if the number of participants is between 80 and 120 at the beginning of the year, and the plan sponsor filed a 5500 in the prior year, then they may elect to complete the return or report in the same category, such as filing as a small plan, once again, the same as they did in the prior year. This next chart is just kind of giving you an overview and some examples of pension benefit plans. And I just want to point out that the newest category that we have added to our chart is the PEP, or the pooled employer plans. This chart also quickly just shows some examples of pension benefit plans that are exempt from Form 5500 filings, such as voluntary 403B plans under ERISA, IRAs, church plans, for example. Next slide is talking about welfare benefit plans. And I just kind of again want to point out here too that if a welfare benefit plan is subject to RISA, it's going to be required to file Form 5500. And the newest category we've added to the list here is the Icra, or the Individual Coverage HRA, which we'll talk about again in a few minutes. There are also exempt welfare benefit plans. Generally, these are small plans, those with fewer than 100 participants at the beginning of the plan year, and that are unfunded, fully insured, or a combination of those unfunded or fully insured are exempt. Just as a reminder, funded means a plan's receiving employee contributions during the plan year, or you're using a trust. So if that's the case, you're not going to be exempt from filing the 5500. I want to just spend a second on voluntary plans because this is a question I get from a lot of clients. If the voluntary plan is not subject to RISA, then you don't have to file you don't have a 5500 filing requirement. Now, a lot of times employers think that there's no employer contributions and the participation by the employees is completely voluntary, then that qualifies as a voluntary plan. We find that that's kind of rarely the case. You have to really tick through all of these requirements to make sure that you're not subject to RISA in a voluntary plan. And I find that they're almost always endorsed by the employer. They're either part of the OE materials or your employer is setting eligibility. There might even be a group contract with the insurer. In those cases, these should be part of the 5500 filing. Fringe benefits such as cafeteria plans, for example, are not required to file Form 5500, but just as a reminder, components such as your health flexible spending account is subject to RISA. That's usually filed along with the medical plan Form 5500. And as you all know, the due date for the Form 5500 is coming up for calendar plan years. It's the last day of the 7th month after the end of the plan year. And also, if you've got a short plan year, kind of pay attention to that. It's the last day of the 7th month after the short plan year ends, and there's certain boxes that you have to make sure you check on the Form 5500 to indicate the short plan year. Many plans I find, plan sponsors need to file an extension, especially if your audit is not completed. If your record keeper is filing the extension for you, make sure that the extension is filed timely. And then also on Part 1, Line D, when you do file the 5500, make sure you've checked the box for the Form 5558. When do you have to, or when can you, stop filing 5500s? So if your plan terminates, you need to file a final return. And you must not file it until all assets of the plan have been distributed to participants and beneficiaries or legally transferred to the control of another plan, or when all liabilities for which benefits may be paid under welfare benefit plan have been satisfied. Again, you need to make sure that you're going to check the final return report box in Part 1, Line B when you're filing a final return. And with that, I'm going to turn it over to Chris, who's going to talk about what happens, consequences when you don't file.
So the next couple of slides that we put together are just a summary of the penalties that may apply if you fail to file the Form 5500 or if you file incomplete Form 5500. So again, as Don indicated, that this is a joint return, so we have penalties on both the IRS side and the Department of Labor. So if you look at the IRS side, I'll just point out a couple of things here. The IRS penalty is up to $250 a day for failure to file a complete Form 5500, or up to $150,000 for the plan year. And then just the other penalty for those defined benefit plans, $1,000 a day penalty for failure to file the actuarial statement or Schedule SB. The penalties get worse when we go to the Department of Labor. They're much higher, and that is a penalty of, for the 2021 Form 5500, $2,259 for each day. And you can see it's going up to $2,400 for the 2022 Form 5500. And then we also have different late filing fees of $50 a day if you file it voluntarily, or $300 a day for non-filers, meaning they come in and you get audited and they see that you didn't file the return. And you can see the maximums there for the plan years. And then Department of Labor also has what I'm going to call if they determine that you have a willful violation, which can be a penalty of no more than $100,000 or imprisonment or both. And then also there's a penalty for making false statements or representations of fact, or knowingly concealing or not disclosing any fact required by ERISA. So again, if you look at the bottom of the Form 5500, you can see that whoever is signing the return is signing it under penalty of perjury, and this is the penalty to the extent that the Department of Labor determines that you violated that certification. Next thing, just as a reminder, because the penalties are so high for failing to file or for filing incomplete, it is always in your best interest to use the Department of Labor Delinquent Filer Voluntary Compliance Program. The IRS is signed on, and so if you go into this program through the Department of Labor, the IRS has agreed to not provide, to assess any penalties. So you are available as a plan administrator to, if you have not been notified in writing by the Department of Labor of the failure to file the annual report, and you have to be subject to Title I of ERISA. The penalty here, so again, if you look at those penalties, which are, like next year going to $2,400 a day, you can see on here the penalties if you go in, if this somehow slips through the cracks. If you're a small plan, so less than 100 participants at the beginning of the year, the fee to enter the program is $10 a day, but not to exceed $750. If you have multiple plan years involved, it's $750 each annual report, not to exceed $1,500. And then moving over to the large plan, so that's going to be greater than 100 participants at the beginning of the year. Again, that same $10 a day, not to exceed $2,000 for each return. And then if you're doing multiple returns, it's $2,000 each annual report, not to exceed $4,000. So we usually, when employers come to us with an issue of not filing, it's usually multiple years, and that $4,000 fee is a steal compared to the penalties that can be assessed. Then just as a reminder here, if you have a non-qualified deferred compensation plan that you have put in place for your top paid group or your management, you're supposed to be doing a top hat filing for that. And so if you failed to do that, that is able to be corrected through the DOL Delinquent Filer Program as well for a $750 fee. Just as a reminder, if you do the Delinquent Filer Program, you must do it through EFAS, except for the Top Hat and Apprenticeship corrective filings. And you can pay the penalty through DFVC calculator or through the mail. Next, I want to talk about who prepares the 5500. So oftentimes, the 5500, sometimes it's prepared in-house by the plan sponsor, but oftentimes it's prepared by a record keeper or the outside auditor is doing the 5500. The filing, however, is the obligation of the plan administrator. So I put a little reminder on here that just as your process as the plan administrator, being the fiduciary of the plan, you need to make sure that you're reviewing a draft of the 5500 and everything looks okay. The next thing we talk about is who should sign. So we went ahead and put on here because I think a lot of times some plan sponsors and plan administrators don't step back and get the right person to sign, or at least this is one of the things we notice a fair amount. Both ERISA, so we put the statutory requirements on here. So you can see ERISA says the plan administrator, so that's your fiduciary, must sign and date the 5500 for a pension or welfare plan. So if the plan administrator is an entity, so if it's the employer or if it's a committee, it needs to be signed by an authorized representative of the entity. And then again, you can see the IRS, the Internal Revenue Code, again, says it's the plan administrator or the employer may sign. But again, to the extent they're subject to ERISA, you need the plan administrator to sign. And then we did put in here that if you are a joint employer, union, board of trustees, or committee, at least one employer representative and one union representative must sign and date the 5500. Also put on here, and this is detailed more in the instructions to the 5500, but if you are having a service provider, if you're authorizing them to sign the 5500 on your behalf, I really recommend that you look at the instructions and make sure you are following the process outlined in the instructions, which we've summarized here. You have to include a statement in the iFile application which provides that the service provider is authorized in writing to electronically file the return. You have a copy of the specific written authorization is kept in your service provider's files. The electronic filing includes a true and correct PDF copy of the completed Form 5500 bearing the manual signature, so you have to make sure that you have the manual signature on file. The service provider advised the plan administrator that the manual signature will be included with the return posted on the Department of Labor website for public disclosure. And the service provider advised the plan administrator or the employer, the DFE, will communicate any inquiries or information received from EFAS, Department of Labor, IRS, or PBGC. So again, if you have somebody signing, if you delegated this to a vendor, please make sure you are following this so that if you are audited, you have the information that you need. Again, the Form 5500, we just wanted to point out, and this has been for a couple of years now, the plan sponsor is no longer required to enter preparer information. And then just wanted to, everybody should be aware of this, that the 5500 must be filed electronically through EFAS. So there's three components of that, iReg, iFile, and iFAS. So we summarized the different pieces there. Just as a reminder, your 5500 is publicly available. So if you were to, for example, go on and type Form 5500 search, it'll get you to the public disclosure room that's maintained by the Department of Labor. So you can find any Form 5500 is on there that was filed on or after January 1st, 2009. I would recommend that you be careful of what you're uploading. Occasionally we will see when we're looking for 5500s, you'll see that there'll be a sheet of paper in there where the Department of Labor says form not available. And that's because there is a group at the Department of Labor that scours the 5500s, and if they see personally identifiable information involving the participants or anything that they're concerned from a data privacy and security, they will pull the form down. The goal, though, as the plan administrator, is to not have that happen. You want to be very mindful of what you are including in the 5500 so that information isn't on there. Just as a reminder, let's talk about what needs to be filed. Obviously, the Form 5500, unless you qualify for the simplified form, the Form 5500 SF. And so I put on here some of the folks that might qualify for that, and then here's just a slide summarizing the different schedules that may apply. And we put a little snippet. The 5500 instructions do include a chart to help you figure out what form that you can file. So you can see the categories on here: large pension, small pension, large welfare, small, and then you can work down through what schedules you have to file. So that's just our brief overview. I'm going to turn it to Dawn now to talk about the content changes to the Form 5500 that we have just been put into place.
Thanks, Chris. Yeah, we're just going to spend the next several minutes discussing some of the recent changes to the Form 5500. And as I've mentioned earlier in that chart, the newest welfare plan to be added to the welfare plan filing was the Icra, or the Individual Health Reimbursement Arrangement. They were first available for plan years effective after 1/1/2020. So if you had an Icra in 2020, the 5500 filing requirement was first due for your 2021 plan year. But just as a reminder that if you have one, make sure that you're looking at that, including that in your filing for this year. I also listed just on this slide, but won't go through it, the requirements. There are many conditions to being able to meet in Icra. Most of all, that the employer can't offer traditional group health plan coverage to employees that are eligible for an Icra. The next thing I just want to point out is the pooled employer plan. As mentioned also earlier in our conversation, the pooled employer plan, or the PEP, is the latest pension benefit to be added to the list of pension plans subject to a filing requirement. And a PEP is a new type of multiple employer plan that's operated by a pooled plan provider. They allow multiple unrelated employers to participate in the plan, and that's employers that don't have a common interest. PEPs were first available for plan years after 1/1/2021, so this year is the first Form 5500 filing for PEPs that were implemented last year. There was a notice of proposed forms revisions that was released by the agencies, the Employee Benefit Security Administration, Internal Revenue Service, Treasury, and the Pension Benefit Guaranty Corporation on September 15th of last year. And some of these revisions were finalized on December 29th, 2021, but it was just a limited number of revisions for MEPs and PEPs for the 2021 plan year. One of the changes for the 2021 plan year were the instructions that a PEP that meets the definition under ERISA Section 343 is a multiple employer plan. And like other ERISA-covered pension MEPs, a single Form 5500 is required to be filed. I will note that I have up here PEP should check the box for multiple employer, should be multiple employer plans. Welfare was a typo. So check the box for multiple employer plans if you have a PEP. The 2021 instructions also say that MEPs and multiple employer welfare plans in this case must include a non-standard attachment that identifies participating employers in the plan by name, EIN, and an estimate of percentage of the total contributions for the plan year by each employer. And it also must include now an aggregate account balance and the information in this new element 4. So here is an example of the standard or non-standard attachment that would be required for these MEPs. Some commenters to the proposed revisions argued that the Secure Act requirement to report the aggregate account balances should only apply to defined contribution MEPs. And the agencies agreed, and the final instructions for the 2021 reflect this. So also the final instructions reflect that the end of the year plan valuation and rounding to the nearest dollar is appropriate to reflect the aggregate account balances. For MEWAs, technically ERISA Section 103G, which governs the additional information with respect to MEPs by virtue of the Secure Act amendment, applies only to pension plans. But the Department of Labor did not agree with the commenters that this precludes continued collection of participating employer information for MEWAs. Here, the DOL in their comments said they were relying on, or in the response to the comments, the DOL is relying on the ERISA Section 103C2, which requires plan sponsors to provide names of fiduciaries and their general authority to require MEWAs to continue to provide information about participating employers. Additionally, PEPs have an additional requirement. They must acknowledge that they believe that they have met their registration obligations, and so there's a new section for PEPs to fill out as well. The Secure Act also permitted plan sponsors to adopt a plan in 2021 and to treat it as being adopted in a prior year. So if you find that you had one of those plans in those situations, the first year to file Form 5500 in 2021, there's check the new E box in Part 1. You can see that at the very end that E is new, and so make sure if you're a PEP, if you adopted a retroactively adopted plan that you make sure you check the box in E in this year's 5500 filing. Also in 2021 instructions were changes to Schedule MB that applies to multi-employer defined benefit plans and certain money purchase plans regarding actuarial information. And the new lines here report the amount of withdrawal liability payments. They reflect revisions to new mortality tables and a new amortization basis to reflect changes that were made by the American Rescue Plan Act. There are also changes required to the Schedule SB that applies to single employer defined benefit plan actuarial information. These new lines require plans to report present value of the current plan year accruals that are decreased by any mandatory employee contributions, requires plans to report plan-related expenses, and there were some changes for some other conforming changes. Similar to the final form revisions in December 2021, the IRS and DOL and PBTC issued final form revisions on May 23rd, 2022 for plan years beginning after 1/1/2022. These changes, again, primarily implemented reporting changes for defined benefit plans and then just a limited number of changes for MEPs and PEPs. Again, the agencies noted that form revisions will continue, and this is based on the proposals that were released in the September 21 rulemaking, in the future. The department said they're still considering 114 comments that they received about the September 2021 proposals. So some of the changes were with respect to the Schedule MB. So again, this is the multi-employer defined benefit plans and certain money purchase plans. If any employer contributions included amounts for withdrawal liability, an attachment must be provided listing the total withdrawal liability amounts and the dates where they were contributed. Agencies are now require also a breakdown that relates to the type of payment. So, for example, whether the payment is part of a series of periodic payments or is a lump sum payment. Currently, line 4F requires completion by a plan that's in a critical or critical status or critical and declining status. Also, the year the plan is projected to emerge from critical status must be reported, or the year that's projected to become insolvent has to be reported on a Schedule MB, and an illustration has to be provided. The agencies clarified in the 2022, or were clarifying for 2022 changes, that the time period for the year-to-year cash flow projections and the basis for those projections, the agencies believe the revised instructions will make it clear that the projections to be reported in the attachments are projections that have already been completed. Some additional changes to the Schedule MB. Currently, line 6 of the Schedule MB is where filers provide information about the actuarial assumptions that are used to determine plan liabilities. Agencies proposed to add a new item, which is line 6F, regarding the interest rate used to determine the present value of vested benefits for withdrawal liability determinations. For plans that do not use a single interest rate, the proposed instructions had required reporting a single equivalent interest rate. There were commenters that expressed concern about the extra work that would be required and clarification of what should be considered in determining this equivalent single interest rate. So the agencies did listen to the commenters. They revised the instructions in final forms, and now the filer must just check the box in 6F to report whether interest assumption for this purpose is the single interest rate, whether they're using the rest of Section 4044 interest rate or something else. If other is selected, the filer then must provide an attachment describing the interest rate assumption. Currently, line 8 of Schedule MB requires filers to report miscellaneous information about demographics, benefits, and contributions. The proposal to modify was requiring additional information in this case. Also, benefit projections. Plans are required to attach projection of benefits expected to be paid in each of the next 10 years currently. The agencies proposed to modify the format to show projections in 3 categories: active, terminated, vested, or in pay status, and the projection period was extended from 10 to 50 years, again, 10 to 50 years. Agencies were really unpersuaded by the commenters that the proposal was either too costly or burdensome, and so they paired these changes with a provision that allows filers to attach the spreadsheet file in a CSV format instead of a PDF file, but they did not reduce the number of plans required to provide projections from plans with 500 or more participants to plans with 1,000 or more participants. So if you've got plans with 1,000 more participants, then this applies. This is an example from the May 22 release of schedules to report additional information about benefits on the MB, Schedule MB. Similarly, there were additional changes that were made to the Schedule SB. Again, the SB is the Single Employer Defined Benefit Actuarial Information Schedule. And so similar to Schedule MB, changes applied to the new requirements apply to plans with 1,000 or more participants, and they require 50-year benefit projections be broken down in active, terminated, vested, and pay status categories as well. Participants here are counted as the valuation date instead of the beginning of the plan year, which is the count date for multi-employer pension plans. And so the agencies were similarly not persuaded by the commenters' objections to cost and burden for the Schedule SB changes either, so the schedule of projections can also be filed in a CRV file format. Finally, the last Schedule SB change, it relates to elective amortization funding relief provided under the ARP Act of 2021. And so if these plan sponsors have elected to have ARP extended amortization will apply before the 2022 plan year, you'd be required to check a box here to indicate the first plan year for which the plan elected funding relief. This chart shows the attachments for both the Schedule MB and the Schedule SB that are permitted to be submitted in CSV format rather than the PDF or text format, basically because of size. There were Schedule R changes made for 2022, and this modification regards the reporting of multi-employer defined benefit plans subject to the minimum funding standards to report identifying information about participating employers. Previously, you had to report employers whose contributions to plan accounts were more than 5% of the total contributions for the year. That's still the case, but now you also have to include identifying information for an employer that is one of the top 10 highest contributors. And then, as I mentioned, there were just a couple of small changes for the multiple employer plans. So in addition to the 2022 final form revisions for DB plans, they've added new plan characteristic codes to identify the types of MEPs, and I've added those here from the May guidance on final revisions. And then secondly, instructions added 2 more options for MEPs to be able to identify who the plan sponsor, plan administrator is, and that is either the pooled plan provider or professional employer organization. So at this point, I'm going to turn it back over to Chris to discuss another important change regarding the plan audit requirements.
Okay, so let's get into the changes to the audited financial statements. So I think folks are starting to get engagement letters and deal with your auditor, and there's been some significant changes on this front. So just a quick reminder on who needs to file an audited financial statement. So we're usually talking about large pension plans, so that's 100 or more participants, and the plan doesn't qualify as a small plan under the 80-120 rule. Again, so then we just did another summary. Don talked about it already, the 80-120 rule. It is some pension plans may be required to file an audit, and some welfare benefit plans, to the extent those welfare benefit plans have a VIVA. We put a slide on here to see, you can work your way through the little arrows to see if you qualify for the small pension plan audit waiver, just as a reminder that that's out there. But we're going to go ahead and talk about the changes, assuming that you are required to submit an accountant's opinion. So let's start what happened. So the Accounting Standards Board issued a new statement on auditing standards in July of 2019. It's called Forming an Opinion and Reporting on Financial Statements of Employee Benefit Plans subject to ERISA. So SAS 136 is the official designation. It addresses the auditor's responsibility to form an opinion on the financial statements of employee benefit plans, and then also changes the form and content of what that the auditing statement looks like now. So this SAS 136 applies to audits of single employer, multiple employers, and multi-employer plans subject to ERISA. It was originally effective, the SAS 136 was originally effective for periods ending on or after December 15th, 2020. But they went ahead and there was a delay that was put out, so it delayed it to periods ending on or after December 15th, 2021. So we didn't see this I am not aware of any auditor that actually went ahead and implemented the SAS 136 changes last year. You could have voluntarily elected to do that. I did not see one last year. So if you had an auditor doing that, I think it was a rarity. I think most auditors were waiting to this year once that delay came out. So what this means is if you're a calendar year plan, your audit now is subject to the SAS 136, and you're probably starting to notice some changes. Again, our goal here is to help you know what you need to document in your files so that you can support the changes, because there are some changes now for the management or the plan administrator, whoever has authority in your organization for the 5500 in the audited financial statements. So let's just do an overview of the SAS 136. So again, the form and content of the auditor's report has now been revised. It has now eliminated the use of the terms limited scope audit and full scope audit. So a limited scope audit is now an ERISA section 103A3C audit, and a full scope audit is a non-Section 103A3C audit. And it has also eliminated the disclaimer of opinion, so the auditor must now opine on the audit evidence that it obtained. Just as a reminder, to the extent that your plan is required to file a Form 11K with the SEC, you would never be looking at the ERISA Section 103A3C audit. You need to do that non-Section 103A3C. I want to look at some changes that the SAS 136 makes to the engagement letter. I want to go over some changes. We're going to talk about the engagement letter changes, changes that to the management responsibility, and then changes to the actual form. So let's talk about the engagement letter. The engagement letter is the auditor now has to put certain things in there and has to obtain certain representations and certifications from management. And again, that might be your committee if you've delegated authority. I'm going to just use the term management to encompass whoever is responsible at the organization for the Form 5500 and the audited financial statements. So the auditor is supposed to obtain from management that it acknowledges and understands its responsibility to maintain current plan documents, including amendments, to administer the plan and determine the plan's transactions that are disclosed in the plan's financial statements, that they're in conformity with the plan's provisions, including that they are maintaining sufficient records with respect to each of the participants to determine benefits due to such participants. The auditor is also supposed to obtain from management that to the extent that, again, that the management has elected to have an ERISA Section 103A3C audit, so that limited scope audit, they have to get a representation that they have determined that ERISA Section 103A3C audit is permissible under the circumstances, that the investment information is prepared and certified by a qualified institution, as that's defined in the ERISA regulations, that the certification meets the ERISA requirements, and that the certified investment information is appropriately measured, presented, and disclosed in accordance with the applicable financial reporting framework. So we now have these representations, right, that the management has to make and in the engagement letter, right? So now that means that if you are certifying, we need to make sure that you are actually doing that in practice, right? Like you can't just certify and then not go through the steps that you certified to make sure that it's correct. I also, before we get off of the engagement letter, please, just as a reminder, these engagement letters are looking very different this year because these certifications have to go in there. If you haven't signed an engagement letter or for future engagement letters, please, as a reminder, make sure that there are data privacy and security provisions are being included in the engagement letters with your outside auditors. Because again, we had the Department of Labor guidance last year, right, that plan fiduciaries are responsible for ensuring that data privacy and security provisions are put in place, including in your contracts, right, with your vendors. So just as a reminder, we are seeing changes, so when you're looking at that, make sure that's in there. Now let's talk about what management needs to do as far as to make sure that it's complying with these certifications. So again, there needs to be an assessment of whether that the entity that is issuing this certification is a qualified institution. You need to ensure that the certification meets those ERISA requirements, gain understanding of which investments and disclosures are certified, and acknowledge in writing that all of the conditions are met and that the ERISA Section 103A3C audit is permissible. So we've got, right, you've got to go through these steps and make sure that this is correct. The SAS 136 specifically provides that the auditor is required to inquire from management how they determine that the entity preparing and certifying the investment information is a qualified institution. So your auditor should be, if they're following the SAS 136, they should be asking for you for proof that you actually did the 4 steps on the following slide. Just as another thing that I wanted to slide into here, the auditor now has to ask management to provide them with a copy of the draft Form 5500 that is substantially complete prior to the dating of the auditor's report. So there's a little bit of a timing change this time. So I did slide that one in here. So again, you can't just certify. The auditor is required to ask you, how did you make sure, right, that everything was in order. So I went ahead and put on here, what is a qualified institution, so that you can look and say, what is that? So ERISA defines a qualified institution or just as a bank or similar institution such as a trust company or insurance company that's either regulated or supervised and subject to periodic examination by a state or federal agency. Well, how do you do all the other steps, right? Like you can kind of look at the qualified institution and say, okay, does this meet the requirements? But how do you do all the other stuff? I want to point everybody to, and this is an excellent tool that was put together. The AICPA, as part of the Employee Benefit Plan Audit Quality Center, actually put in, if you search on your web browser, the language that I put in quotes in here, conditions for plan management to elect an ERISA Section 103A3C audit, they've put together a tool to help plan management determine whether you can make those certifications. So it is a fantastic tool. If you follow the tool, it will get you to document everything you need as far as making these certifications. So it basically starts with walking you through, and it provides some guidance on what is a qualified institution. So it talks about, and again, details all of this. I highly recommend everybody use this, but it talks about that certification from your qualified institution needs to be in writing and signed by a person authorized to represent the qualified institution, and that the certification actually has to certify that both the accuracy and the completeness of the investment information. And so, again, walks you through what that is. So it goes through a series of questions. The first one, for example, is the investment information prepared and certified by a qualified institution? And it has you check the boxes, for example, is it a bank, is it an insurance company, is it a trust company? Question number 2 then, and then it has a space in there for you to document what considerations you took into account to determine that the institution, right, the entity was a qualified institution. The next question it goes into then is the certification signed by an authorized representative. So it talks about many of these certifications, right, the certifying institution will actually include as part of the certification that they're an authorized person. But it talks about in here, if it doesn't do that, how did you as management, obtain certification from the qualified institution that the authorized person signed it? So again, if that statement isn't in there, did you go the extra step to contact your qualified institution and say, provide me proof that the person signing the certification is actually authorized to sign on behalf of the institution? The next thing it does in going through is question number 3 of this tool is, did the qualified institution certify both the accuracy and the completeness? It can't be one or the other. It needs to be both. And so, again, it talks about, steps that you can go through to look at, to look at what that certification is covering. It talks about different things that you need to be asking, right, the certified institution. So again, highly recommend that you go to this. If you follow the steps that's in this tool, it will get you documenting what you need to know. Most importantly, it has at the back of the tool the common deficiencies that they see in these ERISA Section 103A3C certifications. So the first deficiency they identify, for example, is that, right, it was an incomplete certification, or you didn't actually get a certification, right? You didn't get a signed one. And then it talks about, has a section on omissions, errors, and qualifying language in the certification. So, right, does the certification include your plan name? Does it cover all the assets? Is there extraneous language that's in the certification that now raises some concern about whether it's covering the assets correctly? Is the period correct, right? Is it covering a period of time that's not just covering the plan year? So these are all things that management needs to be looking at now. You also, again, it has a whole section in here about the investment information, and it talks about, again, the measurement basis used, right, is including assets that go beyond the plan year. What was the date on which the investments were measured? There's a requirement that at the date that the financial statements are certified, was that the correct measuring information? So you're looking for extraneous language in the certification. Is there something that's making it concerning that it's not covering the appropriate time period? Again, there's also, how are your assets being valued? A lot of the qualifying institutions, right, you need to have an understanding of how they're valuing the assets. If your assets are traded, publicly traded out there, most of the qualifying institutions use a pricing service. But if you have some assets, for example, like in your pension plan, where you're using a net asset value calculation, what are they using? Do you understand, like if somebody's doing the certification for you, do you understand how the assets are being valued, and does that comply? So again, this tool is a wonderful. It's actually not very. It's not very voluminous. I think it's 8 pages long. It is set up in a way that is really user friendly, and I highly recommend that you use that to document your process for making sure that you're complying with these new requirements. Again, so my takeaway here is please make sure that you're setting up these new processes. Highly recommend using the tool. It will help you document the process. Again, you're going to be required to provide this to the auditor. You're going to have to produce how you made the certification that, right, you had a qualified institution and that the certification was correct. And there is going to be now a requirement, right? You're going to have to coordinate with your service providers in the qualified institution. There's probably going to be some back and forth that you're not going to just be able to accept the certification. You most likely are going to have some follow-up questions for them to make sure that that certification is compliant. Wanted to quickly just overview that the auditor's report now looks completely different. This is now the format. The objective of changing the format was so that readers would have a better understanding of the scope of the audit and make clear the responsibilities of the plan sponsor and the auditor. And so, again, just wanted to, it's going to look completely different for you when it's issued this year. And then finally, there was a change to the 5500 with respect to this new SAS 136. You can see on here on the Part 3, the accountant's opinion, you have to talk about, right, you're going to be checking boxes here in B on whether you complied with the, limited, the Section 103 audit now, but that limited scope audit and what you're relying on. So there is now, right, you're going to have to tell the Department of Labor what you're doing. I now want to turn it back over to Dawn to talk about some proposed changes that are coming up on the 5500.
Thanks, Chris. You recall when we discussed the content changes earlier that we started with the Notice of Proposed Form Revisions that was issued by the agencies in September of 2021. And of course, only some of those proposals have been finalized thus far. Some were finalized in the 2021 5500 and some for 2022, again, as we talked about, primarily for defined benefit plan changes to the schedules and for the multiple employer plans, the MEPs and the PAPs. So I thought I'd just take a second here and talk about the remaining proposals from the September 15, 2021 guidance that are still at play, and these are also going to be more expansive than the defined benefit plans and the MEPs and PAPs. And so the first is this defined contribution group reporting and related audit issues. So the proposals would add a new schedule, DCG, to provide individual plan level information for these defined contribution groups, which is sort of a group plans, and the consolidated Form 5500 filing with the plan information, financial information, including the plan characteristics and compliance questions. There's also a proposed new schedule, MEP. It is similar to the current attachment that we discussed earlier, but much more detailed. And then Schedule H and Schedule of Asset Changes, which would be applied more broadly. This would update the Schedule H to standardize investment assets that are required to be included. The agency said this is for improved transparency. They used the actual quote that it would make the financial information more data mineable and accessible for enforcement analysis purposes. It would add specific categories for reporting administrative operating expenses that are expressed as a percentage of assets based on most recent participant fee disclosure or ERISA 445 disclosures. And you'd have to complete the schedule through iFile or using EFAST-approved third-party software. So again, these are just proposed. Their comments are still being considered by the departments with respect to these items. The other remaining proposals would be changes in participant counting methodology. So there's a proposal to change how you count participants for determining when, defined contributions plans a small plan and exempt from audit requirement, for example, would be based on the number of participants with balances at the beginning of the plan year instead of the number of eligible participants. So this could be welcome news if it's implemented. It certainly help those plans if you're hovering around the 100 participant mark to determine whether you're a small plan and whether versus counting all eligibles. And then there's some changes suggested regarding reporting on participating employers for MIWAs that file Form M1. This would essentially transfer the participating employer information from the Form 5500 to the Form M1 for all MIWAs, plan and non-plan MIWAs, but only for providing coverage for medical benefits. So providing MIWAs that are providing other types of benefits would still have to report on the 5500 as proposed. And then really the one that I think caught most people's attention was these plan compliance questions. So additional questions are being proposed on the 5500 asking about non-discrimination and coverage testing, whether a plan sponsor has using design-based safe harbor rules or whether they're relying on the prior or current year testing methods. Questions regarding the use of whether you use a pre-approved plan document, and if so, what is the favorable opinion letter serial number. So these compliance questions seem clearly, to be used to target those plans to designs where errors are more likely to occur. And so there were a lot of comments with respect to those that the departments are still considering. And so with that, I'm going to turn quickly and take some quick look at some common mistakes that plan sponsors and administrators make when they're preparing and filing Form 5500s. A lot of times we see just incorrect information. Might forget to fill in a blank. Filing your final 5500 when the plan still has assets at the end of the plan year. Filing more than one 5500 as a final return, or not indicating that a short year plan occurred, or not entering the plan year on the filing. Not filing a Form 5500 for welfare plan when a participant count exceeds 100 and you were supposed to file. Missing plan feature codes or using incorrect codes, and then oftentimes I see inconsistencies between entries that are just carried forward from one year to the next. And so really here, and Chris had mentioned this earlier, make sure you're reviewing your draft Form 5500s and your audit reports carefully before you're filing. And with this, I'm going to turn it over for the last few minutes to Chris to talk about some audit triggers.
So yeah, let's talk about just audit triggers that come off of this Form 5500, just in case everybody doesn't know. The Department of Labor and the IRS actually, but we see more activity from the Department of Labor. They have a group of agents that all they do are read the 5500s. And so what they're looking for is just, again, different boxes that you're checking on the 5500, because sometimes, right, there's a box that said, did you timely provide your blackout period notice, right? And so if you say no, right, expect an audit on that one because you're just flagging it to the Department of Labor that you didn't comply with the notice requirement. But they're also looking at your footnotes on your audited financial statements and things like that. So you always want to, as I said earlier and Dawn just said, we always want to make sure that you're looking at the Form 5500, making sure that everything is checked correctly. For example, I had a client that was audited and their check marks were off a line. And so that triggered an audit, and the agent said, but you checked this. And I'm like, oh, that was an error. Just that error, because they had things mislined, triggered the audit for them. So again, you do want to make sure that because there are agents specifically looking at this, you do want to make sure that you're checking it. So let's talk about some audit triggers that we see. Again, large amounts in the other assets and level 3 investments. The Department of Labor is known to come in, for example, if they see a high level of level 3 investments, they'll come in and do an audit of that to see, what's going on. And it'll focus just on the investments. I had a client example that showed a significant loss on the level 3, and the department came in and we went through every single alternative investment, and they wanted to see the process of how the alternative investments ended up in the plan, what other investments were considered, right? Was the investment fiduciary and the fiduciaries of the plan educated as to what that investment was and the risks? They wanted to see, right, how those alternative investments, how were they revalued, what kind of transparency. So again, that's something that's going to trigger it. Large amounts in other income, large expenses. The one that we've been seeing in the most recent years is a large number of loans in the plan compared to the plan assets. Again, significant reductions in participant accounts. So what they're looking for from an IRS perspective there is, was there a partial termination of the plan, and did you vest accordingly based on that partial termination? The past 10 years, both agencies have looked at delinquent participant contributions. And again, if you're not aware, go ahead and go to the Form 5500 instructions, because the instructions are very clear on how the delinquent participant contributions have to be footnoted in the audited financial statements and what process you're at. So this definitely, if the Department of Labor sees these, depending on what that looks like, that can trigger an audit, because it's a big moneymaker for them, right? They're going to go in and make you file the Form 5330 and pay the excise tax on that. Often, too, depending on if you're disclosing, just a heads up that we get called inquiries a fair amount from clients about letters getting issued from the Department of Labor advising the clients when they disclose the participant contributions of the Department of Labor Fiduciary Correction Program. And so that's a form letter that is one piece to correct, right, to correct those delinquent contributions. You can go into the Department of Labor program to correct it. You don't need to, and so you should, definitely check with legal counsel on whether you want to do that. Again, we have seen audits triggered off of footnote disclosures. So again, that's why I always say really look at those disclosures and make a determination whether it meets the threshold for disclosure, because sometimes it doesn't. Make sure you understand what that standard of disclosure is and push back appropriately on the auditor with the standard. So we've been able to get a bunch of things not disclosed just by looking at the standard and saying we don't think it rises to the level of that standard. One way to keep some things from being disclosed, for example, is to work out with your auditor ahead of time in the engagement letter a materiality standard, so that certain things under that materiality threshold don't have to be disclosed. Because again, we want to disclose what's required to be disclosed, but you shouldn't just be disclosing everything if it's below the threshold in the standard for disclosure. So make sure you understand that. Because again, what we're seeing is it could trigger an audit if you're disclosing it, and we don't want to trigger an audit based on something that wasn't required to be disclosed. Again, did you have a wrong answer? That's the example of that, right, in Part 4, Schedule H. That's my blackout period notice example. Failure to file a return or timely file for an extension. filing a pension plan Form 5500, but not a 5500 for a welfare benefit plan. Incorrect, varying information like the plan name, plan number, sponsor name. We are seeing quite a few letters generated by the IRS recently. Very interesting to me where we're seeing plan sponsors that did identify to the IRS that they did a name change on line 4 of the 5500. I've probably seen 5 of these in the past year and a half where we've had to write a letter saying, no, we changed the name, here's a copy of the form, basically why are you sending the letter? Failure to attach the audited financial statement and the auditor report when required, and then inconsistencies in amounts that are listed in the schedules A, C, D, and H for insurance contracts, investments, and fees. They're looking, if to the extent that they see things aren't lining up, they're looking at that. So that's just a general overview. Again, I would say the Form 5500, continues to be important. You want to make sure you're reading the draft. Please make sure for the new changes to the audited financial statement, if they apply to you, that you are setting up that new procedure and you are documenting it. Again, I cannot emphasize enough, get your hands on a copy of that compliance tool. If you follow it and fill it out, it will get you to what you need, so that you're compliant. Again, your auditor is going to request it from you. They're required to request how did you make the determination, right, that it was a qualified institution, that the certification was correct, and that it covers all of the investments. So hopefully this was helpful for everybody, and thank you for attending. I guess we'll check and see if we have any questions. I think I tried to answer some as I was going through, and it doesn't look like we have any more.
I think there's one regarding stop-loss coverage and whether it should be reported on Schedule A or C. And typically, employers are paying out of their general assets for stop-loss insurance policy, and so it's not an asset of the plan and not reportable.
Yeah, and I did answer that on there. And we did just have another one come through. Do we have a link to the compliance tool? I think we sent an email out after the fact, right? Confirming your attendance at the webinar. We will go ahead and include on that email the link to the compliance tool, and we'll put that on the email so that everybody has it. So look for that in your inbox, and again, we'll make sure it's on that email for you. It doesn't look like we have any other questions, so thank you so much for attending. Sarah?
Yes, thank you all for attending today. We will follow up with a recording of the seminar today. Again, if you're looking for Ohio CLE credit, please complete the survey on your screen. This concludes our program.